Hey, you guys. Thank you so much for joining me on Blockchain Banter. I'm Jen. I'm here with Benjamin Whitby, project lead at Governor DAO, and Mark Richardson, project lead at Bancor and Carbon DeFi. Last time we spoke, we were speaking to the collaboration, and it was really just super fresh, right? This was kind of a little bit more in the beginning phases of Governor DAO, and it's been a pretty minute. So, Ben, it's wonderful to have you back and joining us. Definitely want to hear about where you guys are at the moment. I know you've got some exciting news coming up and some things, and Mark, you're going to be, helping us out with a little screen share here. But Ben, if I could pass it over to you, maybe just bring us up to speed. What's been going on over at Governor DAO?
Yeah, absolutely. Thank you so much for having me on. Really appreciate it. It's always great to be with you guys. Love you guys so much for everything that kind of is being built and coming through. People can go back and watch kind of the first episodes about me and all that other different stuff. But let's talk about what Governor is. Governor is a general message passing framework. It's a general message passing framework that is built on a fully decentralized stack. The reason that it's fully decentralized is we wanted it to be as permissionless as possible. We get compared to Layer 0, we get compared to Wormhole, all the other general message passing frameworks, Axelar, for example. The difference between us and them is because we're using a single-sided smart contract and MPC, we can control chains like Bitcoin and end up doing native type activity on Bitcoin. That is really important from a tax perspective in terms of not wrapping your coin. It's very important from a systemic risk perspective. We've seen the horrible scenes over the last 48 hours of all the kind of the kidnaps that have been attempted in France. And that
is unbelievable. I was just reading about that. I don't want to cut you off and break your flow,
really
but
scary.
Yeah, I mean, you hear about these sorts of stories, but then you actually see it going on and happening like in the right here, right now, when we're all so, deeply immersed in the industry. It's no joke.
It's absolutely no joke, right? And because we are so early in this evolution in terms of where we are as an industry, we've all relied on these bridges, and these bridges in many cases are secured by multi-sigs, and those multi-sigs put those individuals at risk. So speak about the Arbiton Bridge all the time. It's got billions of dollars worth of ETH locked on it. The 12 people that are securing that contract are a massive kidnap risk, and we've got to have frameworks and control structures in there that allow us to do what we want to do with our tokens, but save the people from kidnap risk, save systemic risk in terms of that way of moving value around in terms of different chains, do it in a way that doesn't incur tax events at every single joint, etc. Not include double attack vectors like wrapped tokens and all these other different benefits that we've spoken about in the past. And we've been building Governor DAO for close to 12 months since we really got cracking on with it. And it's now getting really close to being live. We've got a few MVP products out there that have been used. We've unlocked $500 billion worth of value that can be pumped into Bitcoin through the Ordinals bot collaboration. So
amazing.
Yeah, I mean that's such a big number, right?
Yes, it is.
7 chains. So 7 chains, all the assets on 7 chains. Any one of those can go through and be used to pay for an ordinal on Bitcoin. Amazing.
It's amazing.
It's so cool.
It's really incredible. We had spoken last time you were on about what you guys were building, and we had spoken about the bridges, but just coming back to that really quickly, looking at the different kidnappings, the things that are happening right now, I always say we don't speak about the risks. And I mean, I'm marketing for a DeFi protocol, right? So it's not like it's the pretty side of things, but there are risks, that there's the smart contract risk. There are other risks, and we'll talk about some later, MEV, the sandwich attack and things of this sort, right? But the sort of risk that you're bringing up now, we really don't speak about often enough at all, you know? So it's nice that you are taking that into consideration and looking at the multi-sig and things of this sort. And it's not just the stories from what could happen, it's actually looking at the here and now and saying like, okay, hey, like this is something we're building with you in mind also. You know, there's this security that we're putting into place.
And you guys know better than anybody else out in the market about how important it is to be decentralized, permissionless, have a fire and forget isolated solution that really kind of works. I mean, the narrative that we talk about when we talk to legal teams, regulators, etc., is that DeFi needs to be able to survive a meteor landing on Earth and wiping out all the human race, and somebody new would be able to come along and just kind of get on with things. But to get to that point, it's really hard. So you end up going through a stage of evolution. And obviously our efforts at Governor so far have been about sending and controlling those messages between those various different chains. But because we've been doing that, we have been starting to collect various different levels of fees, small at the moment, but they're what is going to be needed to kind of cycle round, drive that into Carbon, and have that as the final kind of link in the chain. And so it's really timely to kind of come together to make sure that people can understand, have some opportunity, have some headspace to think, right, if I'm going to get involved in Governor, I need to kind of get up to speed on Carbon about how I operate it, how I work it, what the various different positions and opportunities are out there for me. And, not just for Governor, but for everything in terms of the pools and opportunities that Carbon allows you to get into, because the opportunities really are so vast in DeFi. It allows you to move so quickly into areas that the centralized exchanges just can't keep up with at this moment in time.
It's so true. It's so true. I hosted a call and it was how, decentralized exchanges compared to centralized exchanges. And it was, I mean, Mark, maybe I'll pass this over to you, because as Ben's talking about Carbon DeFi and people interacting with it and interacting with Governor in this sense, right? For anybody who's unfamiliar, tell us a little bit about what Carbon DeFi is and why, Governor is, I don't want you to speak for Ben, obviously, right? But why a project would choose to have their market on Carbon DeFi. I know that Ben, when you're talking about putting these different security things into consideration, taking them into consideration, you've also given this a lot of thought in terms of the user aspect as well, right? We've spoken about the different benefits and things in that sense. So Mark, I want to pass it over to you. Tell us a little bit about Carbon DeFi, how it might differ from the other, from some of the other decentralized exchanges. And I know that maybe you are going to do a screen share with us so that they can become more familiar with it.
Certainly. So let me give a high-level description first. We'll get the sort of technical stuff out of the way. The conventional like AMM paradigm is mostly described as a function of token balances, right? And balances being plural in this case. And so a lot of people are probably most familiar with the X times Y equals K special case of the Bancor formula. But the Bancor formula is actually a little bit more general than that, where the token balances at any point in time must satisfy this predicate that effectively their weighted geometric mean remain constant. And so this is the idea that each one of those token balances can be raised to a specific weight, and then the normalized weights of that define the weighted geometric mean. The issue with that kind of way of parameterizing a protocol back in 2017, for example, was that it meant that the slippage was very high, right? And if you wanted to, create a reasonable, liquidity base, it required you know, many millions of dollars to be committed to the liquidity pool. And this is you know, a side effect of the fact that the liquidity pool is defined to never run out of liquidity, meaning that you're effectively supporting prices between 0 and infinity. And because, you know, that is such a wide interval, realistically, most of the trading is only going to be happening in a small portion of that. And so Bancor developed something called amplified liquidity in 2020, which was then sort of rebranded as concentrated liquidity by Uniswap a year later. But the idea there is that you can sort of simulate a larger liquidity pool by, you know, arbitrarily increasing the effective reserves with what are called virtual tokens, which are never traded. And that means that the pool will then limit its trading behavior over a defined price interval. And that's kind of the trade-off here, is that now the pool can effectively run out of liquidity because it's, you know, the price interval that it trades over becomes bounded. The problem with that one, and that's been a successful model, by the way, but the problem with that one is that because the both token balances are tied together in the price quoting functions, it's necessarily a symmetric process. So if you are a liquidity provider, you know, who is committing tokens to these things, you might have, for example, the mind to only sell your tokens at a specific price point, and then maybe a different price point in mind to rebuy them on the way back down or something. This is what's called range trading, or sometimes fading or scaling strategies in sort of more conventional market lingo. You can't really do that with these conventional amplified or concentrated liquidity protocols because the way that their price functions are defined. And so what Carbon DeFi did was to say, well, actually, we don't really need the price function to refer to both token coordinates. Instead, what we can do is let each token balance define its own coordinate space. And that means that the two assets can be priced independently of each other. And what you get from that is actually quite powerful, because it doesn't just abstract some of the behavior of conventional AMMs, but it also represents an abstraction of traditional, like more traditional order books at the same time. Meaning that you can actually, you know, once you've realized what this abstraction's capable of, there's nothing that you can do on, you know, the Binance or Coinbase or whatever order books that you can't do on Carbon DeFi. But there are things that you can do on Carbon DeFi that you cannot do using a conventional order book. And this is because conventional order books, the way that they're typically defined, are discrete, meaning that, you know, when you place an order, it has a certain size and a certain price. And if you wanted to distribute your quote prices over a certain range, it would require you to define effectively each bin of liquidity and its size and its price separately. Whereas Carbon, by way of the price functions that were first defined for AMMs, allows you to price your assets continuously. So it uses continuous calculus rather than discrete calculus. And that's a very, very powerful thing. And I can show you, so that's kind of the technical stuff. What I can do, though, is show you a lot more heuristically what this means when it comes to actually interacting with the system. So we have, and Jen, confirm for me that you can see the simulator up here right now.
Confirmed.
Perfect. And so
Mark,
we have,
do me a favor. You went over the technical, right? As you're walking through this with us, bring it down to like the non-technicals also. I want to make sure that we don't lose anybody. So if they're going to do this, they're really understanding, in addition to the technicals, or maybe if they're not grasping the technicals, what this, you know, means for the everyday user, right? As well.
yes.
And I'll help you with that.
Thank you. Okay, so we built this simulator to help people sort of find their sea legs when it comes to understanding what this protocol does. And I think that in many ways, it's actually very intuitive, maybe more intuitive than even interacting with a conventional AMM. And I'll show you what I mean. If we were to move these bands around, The green band is always determining the prices that you're going to buy at. And then the red band is always determining the prices that you're going to sell at. And you'll find that a lot of traders, everyday users, as Jen refers to them, already have this kind of trading mentality in mind. And you hear it echoed all over Twitter. This kind of, buy the dip and, take profits, that kind of thing. And so this basically automates that process. We're looking at a price chart right now of Cody and Ethereum, and you can see it's got quite an attractive volatility profile for traders. And so we're going to do this in an explicitly sort of look back kind of context. But imagine that we had, begun this strategy with a certain amount of Cody. So I'm just going to put in about $1,000 of Cody. And this Cody is going to be placed inside of this price band so that when the market catches up to it, it finds liquidity there. This is exactly the same as if you had gone to a traditional order book and said, okay, I've got some tokens and I would like to, place them at a specific price, but where those prices are then distributed across a certain range. Meaning in a conventional order book, you would have to place many hundreds or thousands, or in Carbon DeFi's case, actually an infinite number of limit orders to approximate what we're doing here. And then on the downside, we're actually going to have 0 ETH. Now, this is something that, again, is a reflection of the abstraction that you get from Carbon that you can't do in a conventional order book. Because what's happening here is that the Cody tokens that we're selling to the upside for ETH are going to be, as it's converted into ETH, those ETH tokens are then placed back in our buy band automatically without us having to interact with anything. Whereas if you were on a conventional order book, it would require you to interact with the order book after each trade in order to redistribute your funds between these ranges. And so what does that look like when it's actually run?
Now the simulator was
Okay.
created. Oh, there you go.
Okay, so I'll let this animation play out. But what I want you to pay attention to is how these price bands are behaving. So essentially, we started with a certain amount of Cody. I said about $1,000, and as the price crept up into our sell range, you can see it's actually selling off tokens exactly to the point where the price reached, right, the marginal price. But then as those Cody tokens are being consumed, right, we're pulling ETH out of the market, and that ETH then goes into the sell band, which started at 0, but because we sold some Cody tokens up here, they are being added into this lower range to buy those Cody tokens back again. So here we sold some Cody and then we bought some back. And then as the market continues to oscillate, you can see we sold Cody tokens again, bought them back, sold them again, bought them back, sold them again, bought them back. And this oscillation, right, this taking advantage of the inherent volatility in this token pair, since last year, so 18th of May, would have earned 151%. And you can see the portfolio appreciation in the bottom left component of this chart. So pretty good. Like the 151% returns is not
It's
at all
really
bad,
good.
especially not for a liquidity providing strategy. And this is without rewards or any of the other gimmicks that we have in DeFi. This is just pure yield, just benefiting from the inherent volatility that the market's exhibiting by itself.
This is the difference when you're able to determine your own prices that you're trading within, and you're not buying and trading within that same band. You have a designated price range to buy, and you have a separate price range to sell. Right? This is where it really differs from that traditional liquidity provisioning. Go ahead, Mark.
And so, yeah, selfishly motivated users would like to interact with the system for exactly that reason, right? Because if you choose your price bands well, then you can benefit just passively from the oscillations exhibited in the market. But for projects, and especially like whole blockchains and that kind of thing, because a lot of them will make use of specific market makers, and those market makers are accustomed to an order book and not necessarily an AMM, and those market makers will use various hedging strategies and things that are kind of predicated on being able to separate your bids and asks, which is something that an AMM doesn't allow you to do. And so on Carbon, they can do that. But if there is someone that wants to provide liquidity or even buttress their other strategies by providing some sort of base liquidity across an entire range, Carbon, like I said, also abstracts traditional concentrated liquidity protocols. And so here I'm flipping from the what we call recurring strategy, which allows you to set your bids and asks separately, to a typical concentrated strategy, which allows you to combine them together, meaning that, you know, when you're buying a certain asset at one price, then you basically sell it back to the market at essentially the same price, plus a small difference that's usually called the fee, although I've gone on the record publicly saying that I really don't like the term fee and how it's used in this context. But we can do exactly the same thing here. So we'll start with 1, 2, 3, 4, 5 COTI tokens. And because we're providing both sides of the market in this case, it's also going to require 0.15 ETH. And so we're going to play out that same simulation, and I'll point out a couple of things here. The first one, and is going to be the most noticeable, is the fact that it's not nearly as profitable as running a typical recurring strategy is. And so you can see that even though it's trading a lot more frequently, the returns are about a third of what they were with the recurring strategy. Okay, so why would someone do this? There are a couple of reasons. Concentrated liquidity is still good for making sure that there's de facto liquidity available in the market. So rather than sort of selfishly or profit motivated users doing it, it's generally the sort of thing that a market maker might do to make sure that their client is happy, that the market isn't completely devoid of trading activity, or that a project might do because they just don't want to employ a market maker and rather use sort of AMM fundamentals to determine their market structure. And you can do both of those things on Carbon DeFi. So yeah, in short, you've got all of the flexibility that you would get out of a conventional order book, plus the ability to sort of link orders together, thereby executing a trading strategy over time, which is something you don't get out of an order book. And if you prefer that regular kind of AMM liquidity provisioning style, then we also offer that as well. So there's really nothing else out there quite like what we've built. There are obviously some products that have like much more specialist liquidity mechanics that cater to a specific market type. Things like, exclusively stable coins or something like that. But in terms of like generalist, or adopting a generalist attitude, I think that Carbon DeFi really has captured the other 99% of what we would expect from a DeFi protocol.
Mark, thank you for showing us, both of those simulations. I want to bring it back a second, maybe to something even simpler. Say somebody is like, the governor token isn't live yet, right? So it goes live and the project is putting their, creating their market on Carbon DeFi. They're making their token available. How would somebody even go in and, make a lot of AMMs? You just go in and you swap, right? But we were talking about certain risks and things earlier. And this is when I mentioned like MEV sandwich attacks. And this is something that Ben and I were talking about, is one of those benefits that he's happy to bring to his new community, right? Like token holders, anybody who may be interested in participating in this sense. So let's look at those as well, like the basic sort of introductory pieces of Carbon DeFi.
Okay, well, you can interact with it as a taker if you like, the same way that you might, any other exchange that you want. So let's say that we were going to sell some ETH at the current price, and we put in, let's say, I don't know, something reasonable. Actually, we don't have a lot of ETH liquidity right now. So if you were to trade it directly against the order book as it currently exists on Carbon DeFi, then you're basically routing through the strategies that it currently has available to it. And this is, I think, the mistake that most people make when it comes to trading in DeFi more generally. Because anytime you're coming to a front end, including this one, and trying to trade against the book as it sits, you're probably missing out on where that deep percent of aggregate liquidity that exists elsewhere in the market. And there are a couple of ways that you can not make that mistake. One would be to try and use a liquidity aggregator, but then those aggregators, you're still at the mercy of however those aggregators are routing their orders. And you can, while you've got a better chance of getting a better rate, it's by no means a complete failsafe. So what I would do is have a look at the current price, 2582, for example. And instead of trying to trade spot, what I would do instead is to place an order at exactly this current price. So I can see the market rate is currently sitting at 2582. And so I can put my, my quote price exactly at the current market, or just click this button, use market, and then put in, however much ETH I want to sell at the current price. And then that will quote to the rest of the market the price that I'm happy to take. And because we are currently sitting at this price, we would expect this order to get executed almost immediately.
So you're saying to the rest of the market, really quickly, just to backtrack. Earlier, when you said that trading spot, you're trading against the book, right? This is kind of general, like, language for the pool in a specific AMM, something of that sort, right? Not necessarily the order book. This isn't just order book specific, but AMM DEX specific, or like general, right? But here, when you say that you're offering this to the market, this is something that traders can come in, or, this can be filled by aggregators. This could be filled by somebody else who's going in and interacting with the front end. So maybe just clarify what you mean when you say you're offering this now, right, to the market.
Exactly that. You are, when you go to eBay and try to list your PlayStation 5 or whatever for, $500, you're offering your PlayStation 5 to the market for $500. Now, eBay is under no obligation to find someone for you, but people are looking. And this is essentially the position you take. You become a seller, right? No matter what your position is. So when you put your ETH here, and this is a lot of ETH, I just realized, let's back it up. When we put this ETH here, and are asking, specifically $2,582 for it, it gets advertised, broadcast, right? By way of the Ethereum blockchain, assuming you're interacting with it on Ethereum layer 1. And there, all kinds of people are going to be looking for it, including, as you point out, aggregators, solvers, including solvers on other protocols, right? Like the CowSwap solvers will use this liquidity. Our own arbitrage system will use this liquidity, and so on. And so because you're posting that order, you suddenly have access to a much larger, much more aggressive, and much more efficient market than if you're trying to trade spot by yourself. Now, there are going to be some exceptions to that. For example, you could be an ultra sophisticated, blockchain developer who's running their own arbitrage system or whatever. And there, you may be able to trade spot at a rate that is, competitive with what you would get here. But for everyday users, being able to just say the price you're comfortable exchanging your assets at, and then advertising it and waiting for someone to trade against it, is infinitely more reliable than trying to use an exchange front end and trading spot.
When you say reliable, do you mean in terms of the execution price that the user is going to receive? What do you mean when you say reliable?
I mean reliable in terms of getting a good reliable rate. in terms of the rate that you are here. You're guaranteed to get the rate that you advertise. If you're trading spot, you have no price guarantees at all. You can use things like flash loans and other things to try and or min rates, which are often offered by DeFi front ends, But you really have no guarantee. You might just get, for example, transaction reversions. You can get front run. You can get sandwich attacked, and so on. When you're posting a price this way, there is nothing to attack, right? It is impossible to get front run or sandwiched, and you can only get the price that you stipulate. So it's a very, very safe way to trade.
It's funny because, you know, when I first started in DeFi, it was like 5 years ago, and I would make swaps, and it was like, why? I would look at the current market price and I'd say, okay, I'm going to sell 100 of these. And then I would figure I'm going to get this much money. And this is how, you know, and then I'd look and it was like, I don't understand where the rest of everything went. Like, why don't I have what I thought I was going to have? And it sounds silly, right? Like, Ben, you're smiling, you know, but when you're new to DeFi and you're thinking this is the price that it's showing me, and I'm making this swap now, why all of a sudden do I have a different price? You know, like it doesn't make sense. And this is something that I think kind of we may forget to talk about sometimes because we've all been in the industry for so long, but it doesn't matter how long we've been here. We still have new people that are entering DeFi every day, right? And they are introduced to the AMM like this is the norm and this is accepted and this is how DeFi should be. This isn't really at the end of the day how DeFi should be at all. When you look at Carbon DeFi, it looks different, right? It might be like, I'm not quite sure what I'm doing, but it's eliminating so much of that stuff that you don't see when you look at a simple swap interface, right? You're walking away knowing that whatever price you name, that's what you're receiving. There is that sort of price certainty. And that's nice for users to actually be able to have and not have to know about slippage and sandwich attacks and things. Mark, you weren't sharing your screen anymore. I was going to ask you another question about it.
Oh, sure.
Do you mind?
No, not at all.
Okay. We're just going to play out a scenario, right? I'm in Ben's community and I have not gotten any of their token yet. I'm going to bring you back up on screen. I'm a new user. I want to go to Carbon DeFi. I want to get some of, you know, Governor token, and I am not quite sure what sort of price I want to buy at. I'm thinking maybe I'm going to, you know, start buying at this price, but I really think it might go down to this if the market turns around. Tell me about range orders, because this is a solution for the like an indecisive sort of user, like myself. I say that with love because I am that sort of user where maybe it could go a little bit lower. Maybe it's going to go a little bit higher. I don't know if I should buy quite yet. I don't know if I should sell quite yet. This is me. So how would you, like, what sort of feature do you bring to users like myself?
Sure. Well, as you said, Governor doesn't have its token out yet, so we'll have to use a stand-in. I'm going to switch from ETH to 1inch, right? So
okay.
When Governor has its token out, you know, there will be liquidity sources on DeFi, and as you know, as Ben has already suggested, you actually will be able to trade spot on his token with, you know, on Governor's token with relatively high confidence. But if you didn't want to trade spot, what you can do is actually assist the liquidity in the market by creating bids and asks. So what do I mean by that? Let's say that, so this is the Governor token instead of 1inch. Let's say that we're happy to buy some of this token now with USDC at exactly the market rate. Okay, and so we could, you know, use this number as quoted from our front end, and this data is aggregated from a number of different sources. But maybe you go to, you know, CoinGecko, CoinMarketCap, or somewhere else, and you put in the number that you want to trade at. And then you would say, okay, and I'm happy to, you know, to buy, let's say $100 of you know, Governor token at this current price. That's basically it, right? If you want to buy it at the price that's reported, this is how you would do it. And then your USDC will be offered to someone in exchange for, you know, the Governor token. Now, maybe you're, you know, more of a like bargain hunter, and so rather than wanting to buy, you know, all $100 at the current price, maybe you would prefer to wait until the price drops a little bit, right? And so we can do that by moving our bidding price down like this. So for example, maybe you think that, you know, after this relief rally, the price is going to come back down to check the prior highs. That would be around 0.21 in this case. Then we can just offer that price instead, right? Or maybe you're even more ambitious and you think the price is going to come further down here or all the way to the range lows, whatever. It's really up to you to decide, you know, what your offer is going to be. Now, this single narrow line is suggesting that we buy all of our tokens at the same price. But what we could do instead is use a ranged price. So maybe we are happy with the current market price now, but we think that it's going to come down from here. So what we can do then is stretch our liquidity, which in this case is going to be USDC, over a range of prices. And as the market comes down, it will sort of take smaller bites of those USDCs that are available. And so you will accumulate your governor tokens more gradually and at a faster rate or at a better rate the further down into the range that you go. Then let's say that, so that's how you would buy governor tokens. And this is, I think, another reason why projects like Carbon DeFi so much, because users can come in and actually post prices. And when they do that, it actually improves the liquidity of the system. Whereas when everyone is only trading spot, you can actually stress the market and you get a lot of, let's say, undesirable consequences from thin liquidity provision under those situations. So that's for buying. For
so
selling,
this is what I was saying. This is for me, right? If I'm new and I am not quite sure, I don't want to miss out on my opportunity to get governor token before the price goes up. You know, I'm happy with the current market price, but maybe it might go down a little bit. I'm not quite sure. I'm the person who would go in and create that buy range.
Yes, correct.
Yeah.
Yeah.
Go ahead.
So
You were saying and selling.
So yeah. So when the governor token is out, and let's say you've got, like I said, a budget of $100 that you're going to use to buy governor tokens with, then what I might do is set a relatively tight range, something like this. So between 24 cents and 20 cents, and basically just wait to see if the market comes down to that range. But it means that I don't have to wait so long, right? The deeper I set this, the more I'm going to have to wait for the market to capitulate before I accumulate the tokens that I want to accumulate. So you don't want to be, you don't want to be too ambitious. And this is a guessing game, really, because no one really knows which way the market is going to go. All you know is right now, the current market rate is this. And so if you're in a hurry, you want to get your range as tight and as close to the current price as possible. If you're not in a hurry and you won't worry about the fact that maybe the market will move on without you and you miss your opportunity, then you can set wider ranges and set them lower and lower. That's basically the decision-making process here. And then selling is exactly the same, right? If you already have governor tokens, then one of the things that you might do is, if you wanted to sell them at the current rate, then you could set a straight limit to try and sell everything at exactly this price point, which is exactly the demonstration that we had for Ethereum just 5 minutes ago. And if we had a range, it's exactly the same thing. I can set this as wide as I like, and again, this is something that token projects find useful, because a lot of the time the project itself will have a treasury in its own token that it would like to sort of scale out of as the price rallies. And then by providing liquidity with it as a pure sell order here, has a double benefit, because the project is providing liquidity, meaning that new consumers can come in and buy these tokens from the project in a relatively reliable way, meaning avoiding sandwich attacks and so on. And at the same time, the project doesn't have to worry that if the market turns around and comes back down, that they would be forced to rebuy their token if that's not something that they wanted to do. So yeah, that's the selling side of things. And then if you're a slightly more motivated trader, one of the things that you might consider then is that that linked order strategy, where we don't just have a target to buy our tokens, but we also have a target to sell them. So let's say that the governor tokens just come out today and it's hovering around this price. We might set a relatively tight buy range immediately below the current price. And then to the upside, we can say, you know what, I'm happy to scale out of these tokens when we get, something like a 50 or 100%, increase in price. And that's all you would need to do. You would set this strategy up once. When your order is filled to the downside, that's it. You've now got the governor token, and then those governor tokens will be held and won't be sold until it reaches your other target price. And these are, predicated by the protocol.
And then when those governor tokens are sold, they go back into the whatever you acquire, right? If it's USDC, goes back into the buy range. So if the governor token goes back into that buy range, then I'm automatically rebuying and re-entering my position with governor. Now, you're talking about like when the token first goes live. Am I able to adjust those prices? Maybe I want to get back into governor, I want to create this sort of strategy, and I sell where my sell range is. I'm going to buy back in, but I don't really think the price is going to go as low as it did when I originally bought, right? Can we talk about the adjustability factor of that, how you can go in and edit your prices? I'm not obligated to keep that specific price range that I've initially created my strategy with.
Yeah. So these strategies are infinitely customizable. So unlike other systems where you'd need to sort of delete your strategy and then create a new one or something like that, each one of these cards represents an NFT. And when it's your NFT, you can go in and basically change the settings on all of these things. So let's say that you went in and performed a strategy creation like the one that we just set at any time. Maybe it's immediately, maybe 5 minutes later you change your mind, maybe you change your mind 5 months later or 5 years later. These prices can be adjusted at any time.
Perfect. Ben, do you have anything you want to add?
I'm blown away every time I see this demo. Thank you, Mark. I mean, it's amazing. It was amazing the first time that I saw it when we first spoke all those months ago. It's amazing now, and I cannot wait for more people to really kind of experience the Carbon DeFi position, as opposed to the frustrations that people have got for dealing with all the different kind of levels of centralized exchange and DeFi exchanges that exist today. The one thing that I would say that I'm really excited about as well with regards to the kind of the different sell levels and buy levels that we're just talking about is, of course, at the moment, we're only doing one particular user view. So you see your view on that particular position. When you come in as a buyer and you're buying, you will buy from many different positions in the market, as it were, because you'll have many offers put in front of you, so you'll see that depth of liquidity in that book. We've spoken before about the protocol buy and burn methodology that we call the furnace, and that's exactly what the furnace will do. It will come along and it will sweep the order book and the offers of the lowest paper hands in the order book, and then take those tokens and burn them forever. So we're going to end up for the governor protocol with a infinitely decreasing supply of tokens that are never going to kind of ever come back. So it's a different market dynamic to most people would be aware of in terms of that two-sided market squeezing the balloon. Every time the protocol steps in, the balloon actually gets a little bit smaller as well. So it's absolutely perfect for that. yeah, and I can't wait to kind of get people kind of using it, making sure that they can set up their various different strategies and really get into the details.
And really not have to worry about a lot of the things that you normally worry about when you are going to just swap and things of that sort, you know? So it's nice to just eliminate that and go in and say, I want to buy at this price. Done. I'm walking away from the charts. I'm walking away from everything else. And this is it. It's done. I'm selling at this price. I'm done. I'm walking away. You're not watching the market and panicking. I mean, like, are we entering a bull run? Are we been in the bull run? We don't know. But eventually there's a rally and you want to exit your position at some point, and we all get emotion and we all start, you know, feeling different things, and it becomes more difficult to make a decision, right? Than when you're kind of, you create your position or your strategy and you implement that and you just walk away. I'm done. So
and people
I'm excited
have,
for your community to really experience this.
yeah, people have different reasons for kind of entering positions, exiting positions, etc. But the scary thing is that when you get involved in an AMM for the first time and you read about a sandwich attack or MEV or some other kind of position where people have lost value, when you start making strategies on carbon, you can do some exceptionally large trades, and be really confident that you're going to get the price, which brings a whole new dynamic in terms of what you're looking to achieve. So you can either do that range trading, kind of take advantage of the volatility, or just say, look, this is my best offer in the marketplace. You come to me when you're ready, and it's a big position and there's a lot of depth and it's high up in the order book, and you'll get it.
Right. Yep. I don't want to sell until I do.
Yeah, exactly.
You know? Yep. Mark, thank you so much for joining us and for, you know, walking us through Carbon DeFi and the different features that it has and the different ways that users and the, you know, the governor community can interact with it. Ben, congratulations on everything that you've been working so hard towards, and everything that you've achieved so far. I would definitely love to have you back, you know, once your token is live, and maybe we can kind of walk through this again, and maybe even get some community members to ask us some different questions that they may have in regards to either the projects or, you know, interacting with Carbon DeFi. But either way, would love to have you back. I definitely, you know, it's always a pleasure. Mark, thank you again. To all of the viewers, thank you also. Ben, if anybody has any questions, should they reach out to you? Should they, I mean, we obviously want them to follow Governor DAO on X, right? Where would they go if they have questions about anything that you guys have going on and they want to join the community?
So we're Governor DAO on X, Governor Official on Telegram. Come in, ask various different questions, enjoy the memes, enjoy the fun and games. You know, we've got this amazing culture in crypto where people are looking to kind of just really just engage at so many different levels. So, you know, there's a joke. It's like, come for the PhD maths, stick around for the memes and
the memes,
the various different type NFT type events.
It's
Brilliant.
So true. It's so true. And anybody who has any, I'll share those links also, you know, after the call. If anybody has any questions about Carbon DeFi or Bancor and what, you know, the Bancor ecosystem is up to, you can join our Telegram. The Bancor Telegram is Bancor Protocol. You could join Carbon DeFi. It's Carbon DeFi XYZ. Same on X as well. And as always, if you guys have any questions about any of the above, you can always reach out to me and I will connect you with our, you know, our guests and answer any questions that I, you know, am able to personally. So thank you all and congratulations.
Appreciate you guys. Thanks so much.
Always.
We'll
talk to you soon.
Thank you, Jen.
Of course. Thanks, guys.